Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand, evidence-based, holistic insights to help you master the game of building wealth. So let's get into today's episode. I'm going to call the first listener Bert because that's what he wanted to be called. It's not his name. Anyway, Bert writes, he's 48, his wife's 46. He earns 350 grand a year. His wife earns 50. They've got 3 teenage boys, live in Sydney, so living expenses are quite high. Home's worth 1.4 with 380 owing. Investment property in Western Sydney is worth 1.15 with $840,000 owing. That was bought back in 17 for 626, so that's done really well. The second investment property in Melbourne, which is a villa unit in Mentone, which is a bayside suburb, but quite a distance from the CBD, or maybe it's 30 k's or something. Anyway, it was bought for 700. It's only worth, well, I shouldn't laugh, 775. Not surprising. It was bought in 24. So, okay, it's only been owned for like a short period of time. In terms of super, all in Aussie super, 750 for Bert and 230 for his wife. So it's about $1 million. And he's maximizing contributions, but his wife's not. And essentially the question is that, borrowing capacity is tapped out. Cash flow is really tight just because of high living expenses with 3 teenage boys and, what to do next. Look, Bert, it's a good question. And, I think I wrote a blog a few years ago, which was really about, how much should you be investing and, what is your strategy? And I think this is a good sort of point around that mark. I think if I was in Bert's situation, you'd really need to work out, he's got 2 investment properties, a relatively small home loan, a strong income, and don't forget Bert's cash flow is going to get better over the next 10 years. I was going to say as his boys move out of home. Maybe I should say if his boys move out of home. But typically, I see my clients' cash flow greatly improving as the kids get older and they get more established and become more independent. And that's a positive as well. But you need to really work out, are you on track? So let me do that roughly for you then, Bert. You're 48. Let's say you've got another 10 years. It's going to be sort of 10 to 15 years, but, So your $1 million of super should be $2 million of super. Well, that's pretty good. You're sort of off to the races there. Let's say your Sydney property over the next 10 years is worth, I don't know, let's be conservative, 1.8. So you'll have about $1 million of equity in that. The Mentone villa unit should double over the next 10 years. So let's call that 1.5. So you'll have about 700,000 of equity in that. So that's about 1.7 million of equity in investment property by age 60, which, let's assume that you're going to pay, well, not assume, you're going to pay capital gains tax. So let's be conservative there with costs, selling costs, all that sort of stuff. That's 1.2. So you'll have $3.2 million of assets in 10 years' time, which is worth about 2.5 million in today's dollars. And in episode 358, which was how much wealth do you need, I worked out that if you spend $150,000, until age 80 and then reduce it by 30%, you'll need about 2.2 million of assets after tax in order to do that, or 2.9 to be able to spend 200. So you're sort of in the middle there, which means that you could spend, I don't know, $170,000 in today's dollars and you'd have enough wealth. So I think the answer here, Bert, is you don't need to do a whole lot. It looks like you're sort of on track. It's really just about optimizing performance. So making sure, the Sydney properties worked. We'll see. We'll find out whether the Mentone property works, but will work in the future. But, you need to benchmark it, not every year because that's difficult, but you need to sort of just get a sense of, well, when the Melbourne market starts kicking off, is your property growing in line with that growth or hopefully exceeding it? That'll be the acid test for that. And then just making sure over the next 10 years, those property investments continue to compound in terms of growth. And if you start or you change your opinion around what their future returns might be, well, you might need to make a change there, which is to reallocate, as I spoke about last week, reallocate that borrowing capacity to a more functional kind of level. And then super, I've recorded lots of episodes in the last few months about super, but it's really just making sure that the fees and returns and all those sorts of things are optimized. But if you can optimize all those things, then you should be on track for retirement at 60. Now, you haven't shared your goals with me. I don't know if that's your goal. I've just assumed that, but that's the answer, I think, is I wouldn't stress so much about not having any surplus cash flow to invest beyond what you're already doing in terms of servicing those investment properties. And, you're in a good position for your age and stage of life, assuming that's what your goal is, retirement at 60. And it's really just about letting time do its thing and optimizing. And of course, if you are able to invest additional monies, well, then that'd be great. Now, what would I do with that? Those additional monies? Because the way I would see it is that you're going to have 2 million, let's say 2 million of super by the time you get to 60, maybe more. And then those two investment properties, the way I would see it is that you want to get the equity in those investment properties into super as well, because that's more tax effective. So say between 60 and 65, you might sell one of those investment properties, depending on how it's performing, and get the money, contribute through non-concessional into super. And then you might keep the other investment property just as like something to fall back on to kind of underpin super, just in case its returns aren't great or you end up spending more than you expect. You've always got that asset, that compounding asset to fall back upon. So if that's the strategy, then debt reduction isn't that important. Of course, debt reduction against your family home, that's the important bit. So if you had additional, or when you have additional cash flow, I think you're going to be able to repay that 380,000 over the next 10 years, but make sure you're putting enough cash flow towards the home loan in order to do that. And then if you had surplus beyond that, well, I think I would be investing in your wife's super account. So instead of investing perhaps in your personal names, maybe I'd be putting money, making concessional contributions into your wife's super account, because that would be a nice tax-effective, cost-effective way of making additional investments. Other than that, then you would do it outside of super, maybe in ETFs and so forth. But I think overall you don't need to do so much as a sort of back of the envelope calculation. Now, of course, this is not advice. It's only information. It's only every information in the podcast. But I guess for anyone that is concerned about this, go and get advice. Go and get someone to build a plan for you. Do those financial projections and just confirm that you're on track. Don't be lured into making major changes if major changes aren't necessary enough. But I think you're on track, Bert. All the best with it. Okay, next question is from Blair. Blair writes, I've been trying to think how to thank you for all the value your podcast brings to listeners like us. It's a challenge because every question seems to proceed with glowing praise, rightly so. I'll simply say this, I've left a 5-star review on my dedicated listener. Thanks, Blair. I know I get so much great feedback. I certainly don't take it lightly, and thank you for leaving the 5-star review. And, for anyone that writes a review, particularly I look at Apple Podcasts, I always read them and I share them with my wife, and just a bit of boasting, and I really appreciate it. So please know, if you do those things, leave reviews, write a review, I read them and I really appreciate all the feedback that I get. And I keep putting more and more energy and effort into making sure that I deliver as best content as I can. Okay, so Blair's situation is he's got a self-managed super fund that has a strong cash flow because he's invested in some partnerships. I imagine, I don't know what that is, businesses or so forth. And he's got an investment property in the self-managed super fund, and then $150,000 share portfolio that has some ETFs and some direct stocks and even some listed investment companies. And Blair's 42 and 44. I guess he's not two ages. I guess that's his spouse. And he's asked, how would I construct a portfolio in his circumstances? And it's a really great question, because I know asset allocation is an investor's most important decision. And why do I say that? I say that because that's the only thing you as an investor can control. You can control when you invest and how you invest. And how you invest means what methodology. So whether you use index funds, direct shares, active management, and then if it's index funds, what methodology you use within those index funds, and then where you're investing, as in, which geographical markets, which sectors perhaps, which market segments, all those sorts of things. But the returns will be what they'll be. You can't control returns, can't really control fees other than, what you select. But what you can control is asset allocation. And so if you look back at asset asset class returns, and I know we've got a table that we use in some of our documents, they're random, they're all over the place. But if you had a crystal ball and you knew what was going to happen, you could shoot the lights out. You could probably produce certainly double digit, maybe 20% returns compounding forever. It's just about the knowledge of which asset class is going to perform best over the next 12 months. And you can then structure your portfolio accordingly. So that's why asset allocation is the most important decision. One of the things that we do in our business that I think adds a lot of value is portfolio construction. And so that's the problem, is that when someone asks a question about portfolio construction, it's very much a time in point analysis. What I would do for a particular client today might be different what I would do for another client, in say 2 months' time with different holdings. And so that's why it's a really difficult question to answer. I mean, I can answer it, but the problem is I don't know if the answer is going to be particularly useful to everyone. And if someone's listening to this episode, say in 3 months' time, I would caution them whether it's going to still be relevant today, which is not to say that, we would chop and change asset allocation, not at all. But it's really about what information do we know today and what are the long-term trends suggesting, and where is our capital best invested. Now, that doesn't necessarily change over a course of a 3-month period, but it could. But it tends to change, say, over a 12-month period. So what we would have been doing last year might be different to what we're doing this year. And certainly what we were doing 2 or 3 years ago in terms of investment asset allocation is different today. So that's why it does sort of change over time. Now, there's 2 schools of thought with respect to asset allocation. One school of thought is that we should adopt a very well diversified asset allocation in our portfolio, because we just don't know which asset class is going to perform best over the next 12 months or 2 years. So then the evidence tells us the best thing to do is kind of spread that across a diversified portfolio. And a lot of financial planners take that to the extreme, where they will have a model portfolio that they will just run across all their clients. And if that model portfolio says we want 0.5% invested in China, for example, and then someone has 0.6 invested in China, they will sell down to 0.5 and rebalance the portfolio. Now, that's a really scalable way of managing a whole bunch of different accounts, so hundreds of different client accounts. But we don't think that's the right approach in terms of managing portfolios. And because this podcast and I'm answering Blair's question, I thought I'd point that out, because you have the opportunity to structure your own portfolio and minimize transactional costs, and you should always try and do that. I can hear listeners saying, shut up, Stuart, just tell us what you're going to do. Okay, so let's look at some of Blair's existing holdings. He's got AFI, which is Australian Foundation Investment, one of the longest, I didn't research it, but I think pretty much one of the longest listed investment companies in Australia, and has underperformed. It tends to track, I haven't checked this again, tends to track at a discount to net tangible assets, which is always sort of frustrating, because all it does is own listed shares and you're getting that at a discount. Well, if it ever came back to net tangible assets, you'll make a gain, but unfortunately it's always traded at a discount. But the longer term returns just haven't been acceptable, and it's active management, so it's not in line with the methodology that we would utilize, and it's a long history of underperformance. Blair's got 23% of nearly 24% of the portfolio in that. I would move it on. I get rid of AFI. He's got Xero, which is the accounting software provider. It's pretty funny. I've been a bit negative on Xero, and the market's not agreed with me, in terms of its share price. It's trading about $163. Towards the end of 22, it was down to 73. And I think Blair said he bought it for $28. So, he's made a significant gain on that stock. My challenge is, cash flow, dividend yield, valuation, all these sorts of things. At some point, it'll come home to roost. I remember having these conversations and maybe even talking about it in the podcast about Afterpay. I don't know if anyone remembers, sort of back at the beginning of COVID, Afterpay was a darling stock of the market, but didn't make sense to me, and it eventually blew up and didn't work out. So look, I don't understand Xero's valuation. I don't invest in anything I don't understand. And so, yeah, I would take profit. If I was in your shoes, I would take my money and absolutely run for the hills. Okay, then he's got VGS, which is just Vanguard International. He's got VAS, which is Vanguard Australia. He's got VDGR, which is Vanguard Growth, Diversified ETF. And then he's got 3 other direct shares, Deep Yellow, and then a couple of energy ones, Bannerman Energy and Palladian Energy. I don't know about any of those stocks, and looks like none of them actually making money in terms of none of them are reporting a PE ratio. So, I can't really critique an investment decision that I didn't make, but there's about sort of just shy of 10% in those three direct shares. I don't believe in investing in direct shares. I certainly don't believe in investing in direct shares that don't make money, because the ultimate thing with shares is you want productive value. Well, there's no productive value when there's no free cash flow and profitability. Otherwise, it's just a speculation move, and I don't speculate. So I would get rid of them because I wouldn't have bought them in the beginning, but you've got to return to your own investment thesis. So let's say we get rid of the listed investment company, Zero, and the other direct shares. We're then left with Vanguard International, 15% in there. Well, we've got probably an equal share against Vanguard International, and VDGR. So we're sort of just replicating or doubling up here, but it was essentially 50% really in Vanguard Australia and 50% in Vanguard International. So that part of the portfolio then is all market cap indexed. So then the way that I would then think about it is to say, okay, well, I'm happy with market cap indexing, but the only part of market cap indexing I'm unhappy with is the top 10 companies. And the top 10 companies now make up a huge part of the market, valued at huge PEs as a sort of weighted average sort of PE, and have driven most of the market returns really since the start of 23. So, you've got a huge concentration risk there. And so then what I would do is build an ETF portfolio around the core. The core is market cap indexing, which is Vanguard. So I'm happy with that because we've got to take kind of an each way bet, and then I build around that. So for my Aussie exposure, I might introduce fundamental indexing. So that's QOZ, and I might introduce mid cap because to dilute, the concentration risk we have in Australia being the banks and miners. So I'd use X20, EX20 there. And then for the international stuff, I bring in some value-based allocations or some XUS. So XUS would be VEU, and then the value would be VVLU, which is the Vanguard Value Fund, and VLUE, which is a Van Eck Value Fund. The Van Eck one has more technology in it, so it's still growth at the right price. So I'll be using both of those, as well as then dimensional, which is DGCE. And so I would be using those. I'd still probably keep a 50-50 or around about a 50-50 split between Aussie and international. So I'd leave the Vanguard stuff, and then I'd put 50% in Aussie and then 50% in international. And probably the best way to do it would be, well, there's no real compelling reason to go otherwise, but I'd probably put maybe equal weight into the equal amounts into QOZ and X20. And you might even add a dimensional in there as a third option as well, which is DACE. So put 1/3 in each of those. And then with the international, same sort of thing in the spread across those 4 ETFs that I just spoke about, which is the 2 value, the 1 XUS, which is VUE, and then the dimensional international that I gave you. And by doing that, you're still going to have really 50% in international, 50% in Aussie. But then what you're going to end up with is a variety of index strategies that should accommodate most risks moving forward. And you might be sort of in international, overweight non-market cap indexing. So if you're going to keep investing in international, I'd be putting it in those 4 that I just spoke about, and probably no more in Vanguard International. So I hope that helps, Blair, and I hope it helps other people in terms of understand portfolio construction. The problem with it is a point in time thing, and that's where, the value as advisors, I think we add is that over time, we're going to make changes to that allocation, and we're going to reweight a portfolio by maybe concentrating on one particular area or one particular strategy in order to reweight a portfolio. So giving you the answer today doesn't give you the answer to follow for the next 10 years. And that's why I'm kind of reluctant to answer the question, because I don't want people to extrapolate it and then think that's the answer and unfortunately expose their portfolio to greater risk or lower returns. But anyway, I've provided the caveat. It's not advice, merely information to demonstrate kind of how we approach portfolio construction, which I think is a really important decision. Okay, next one is from Bryan, which is kind of an interesting one. Probably a little bit of confession time coming up for me. So Bryan writes, my question is really asked on behalf of my kids. If you were to start out your investing journey all over again, what would you do differently starting from when you left school? And how should that person think about money and investing going into their 20s, 30s and 40s, etc., as they reach up to 60, looking towards retirement? I have a daughter that's 18 years old and studying nursing in her first year of uni. She's working part-time and has for about 15 hours a week. She has some scholarship money and will have a HECS debt of around $18,000, which after she graduates from uni. Should she pay off the HECS debt with the scholarship money or work or save and use the scholarship money to save for a home deposit and also have any remaining HECS debt gradually paid off through mandatory salary deductions? Thank you for answering my question. Really appreciate your thoughts. Well, Bryan, what would I do differently? Gee, I guess if we asked everyone that was 50 years or older, what would you do differently? You might have a long list of things, right? But I mean, financially, when I left school, I was an idiot. I don't mind saying that. Like, I didn't save. In fact, I made a whimsical decision to join the army after my father was seconded to the UK. We lived there for a year. I came back. When I came back, it was halfway through the year 12 year. I got like a certificate of equivalency, so I didn't have to go back to school, although I went and studied at a TAFE and just to fill some time and worked and so forth. And then I just woke up one day and said, I'm going to join the army because I want to save some money to buy a car. I joined the army. I was in there for 12 months full time and then 4 years part time. It was a different sort of arrangement anyway. And I left the army after 12 months with not a brass razoo in my pocket because I'd spent all the money like an idiot. So I don't think you want to take advice from me. Having said that, when I read Bryan's question, I thought, well, do I regret that? Probably not really. I mean, it hasn't changed my life, really. It's all worked out fine. And, you're only 18 once. But I probably would have maybe, you can probably assume a little bit more balance than what I had. So when I was younger, I was not a saver, I was a spender and didn't really think about property or anything like that. And in fact, I can remember when I graduated and had my first job, I was going for a walk around Melbourne because I grew up in Geelong, moved to Melbourne, just thinking like, how does this property investing work? Why would you lose money on property and trying to work it all out? And it wasn't until I read a couple of books about it that it started to make sense. So look, I think education is the first part, right? Because that's what I was missing. So, what is the opportunity cost of spending all your money like an idiot? How does investing in property work? All those sorts of things. Just building good initial habits, good initial cash flow habits, which to my mind isn't save everything and do nothing. It's always got to be about balance to my mind. So it's really about, saving a reasonable amount, but also spending some for today and enjoying the process of building wealth. And then educating yourself really about what are the key attributes, the key things that you need to really focus on. So if I was your daughter's age, I wouldn't worry so much about the HECS. What I'd want to do is keep as much cash and investments in my personal name. Away from super and away from repaying HECS, because the first thing she needs to do is buy a property and buy the best quality property that she can afford at the time. But you really don't know what that looks like yet. You don't know, will she complete a nursing degree? Where will she work? Where will she invest? What does that look like at the time? We've got the government guarantee in terms of you only need a 5% deposit. Will that change? Who knows what the future holds? So whereas if you repay HECS, it's gone forever. You've lost that flexibility. So what I would do is keep all the savings in personal name. Maybe invest a little bit, get to know the stock market and ETFs and get comfortable with that. And then when finish uni, go and find a job, make sure you're comfortable in the occupation and the job and so forth so that you've got, some confidence around longevity of that situation. And then as soon as possible, once that person is comfortable, go and buy a property and get into the property market. It's really it's a no-brainer in terms of the first thing a young person should do, because it's all about sort of building wealth and building equity and doing all those sorts of things. And then I think it's just still constantly education. I met with a client yesterday and we were talking about a particular matter, and he said to me, professional advice pays for itself. I've learned over the years that, professional advice is essentially free because you get the value you get exceeds the cost of the advice. And one of my mentors used to say that exactly the same thing to me. You always pay for professional advice. It's dumb if you don't. And people either learn that eventually through experience, bad experience, or hopefully they can can learn it through counselling. So I think educate yourself, do as much as you can, but then know your limits. At some point, perhaps most people will need advice. They'll get to a point where it starts to become too complex. Not everyone, and I'm not saying every Australian, but I'm saying everyone that listens to this podcast. At some point, they might need advice, but that's okay. Get as far as you can. Follow an evidence-based approach. Have good money management habits, which is really tracking what you're spending and have some balance. I think that's really all you need to do. And it's something that I haven't necessarily had, through my entire, from age 18 through to age 50 as I am today. But looking back, that's probably what I would do. There's been periods through my life, particularly when I started the business, and I went through a marital separation. So there's been a few periods of my life where I haven't been investing, and that's just dumb. I should have just invested all the way through it, and I would be in a better position today. Okay, final question I'll cover today is from Ron. Ron writes, thank you for your valuable insights you shared through the podcast. Over the last 2 years, I've become much more financially literate thanks to your practical advice, and I truly appreciate the way you break down complex topics. Thanks, Ron. Hopefully I can do that for you today. I'm currently weighing up property versus shares strategy and would appreciate your perspective. And I'm just going to paraphrase here. Ron's been in touch with the buyer's agent. The buyer's agent suggesting buying for 1.2 terrace in Melbourne's inner west to inner north for 1.2 million, and the rent expected is about $22,000 a year, which is pretty low, but that's probably because it's a high land value asset. Sounds pretty good to me. And based on a capital growth rate of 7%, Ron's worked out that it'll be worth, in 30 years' time, $9 million. He says, in contrast, if he invests the same $6,000 a month, which he needs to service the loan repayments, into ETFs, assuming an average return, it'll also $9 million. So he says, aside from diversification, I'm trying to understand the core benefits that might justify prioritizing property in this scenario. Interested in your thoughts, etc. So firstly, Ron, I'll refer you to a couple of things that you can just Google because I don't have episode numbers, but back in 21, I wrote a blog called Property versus Shares, a Practical Comparison. So if you just Google Pro Solution, Property versus Shares, a Practical Comparison, it'll take you to that blog. And there is a podcast there, so you could search for the podcast if you wanted to listen to it. And then in 23, I wrote one called It's All About Gearing, Not Property. So again, if you Google Pro Solution, All About Gearing, Not Property, it'll take you to that blog. And again, there's a corresponding podcast, but didn't have podcast numbers back then, episode numbers, I should say. I don't know if I agree with your numbers, Ron, like in terms of saying, well, property is going to end up generating the same amount of wealth. The only way that's going to be the case is if you include gearing. But normally in a sort of property versus shares debate, it's borrow to invest in property or put the cash flow into the stock market. And that's where it's not a property versus shares decision typically, well, not typically, almost always it's not a property versus shares decision. I would reframe it as a gearing versus not gearing. If you're going to gear, then property is the best asset to use because most of its return is in capital growth. You can borrow a high proportion of the property's value, and if you've got equity in existing property, or the entire cost, and the interest rates are pretty competitive. If it's not gearing, so you're just investing $6,000 a month, then shares are going to be probably a better option. For all the reasons that you suggested, liquidity, diversification, flexibility to sell down part of the portfolio, more predictable levels of income, less time requirements. You don't need to deal with property managers or tenants, or less chances of changes in legislation, so around property rules and tenancy rules, all those sorts of things. The only way, though, a property versus shares comparison can end up generating the same amount of wealth over a 30-year period, as Ron has suggested in his question, is if you include gearing in both. Right? So if I'm going to go and borrow 1.2 million, buy a property, or go and borrow 1.2 million and put it in the stock market. Now, I just wouldn't borrow 1.2 million and put it in the stock market. And I certainly wouldn't do that when the stock market is trading at all-time highs. In that comparison, shares probably works out better if you balance out the qualitative and quantitative characteristics. But the thing is, it's just not a practical comparison because it's a very aggressive approach to go and borrow more than $1 million and dump it into the market in one hit. And so I just wouldn't do it. So typically in this comparison, property is going to generate more wealth. And so I guess the answer to your question, Ron, in terms of deciding which strategy or tactic, I should say, is most appropriate to your circumstances, it's really just about what return do you need. So, for example, I'm just going to use Ron's numbers. If I go and buy a $1.2 million property and it ends up being worth $9 million in 30 years' time, and let's say I look at an ungeared share strategy where I'm investing $6,000 a month, if that's going to end up being worth, I don't know, say $5 million in 30 years' time, does that differential, that delta, that $4 million difference, does it make a difference? Like, is Ron going to end up with more money than he'll ever need this scenario? Or does he need to actually swing for the fences and include gearing and take high risk to get the 9 million? And that's what I would consider. That's the first thing I would consider in terms of deciding which way to go. But of course, I don't know the rest of your circumstances, your age, your other assets, all those sorts of things, what your goals are. So I can't tell you which way to go. But that's what I would say in a property versus shares debate. It's really about gearing versus no gearing. And gearing is always going to win, almost always going to win. Right. And if you refer back to those two blogs that I referred to at the beginning of answering this question, all the answers are in there. But gearing's typically always going to win as a strategy to generate the most dollar value of wealth over a long period of time. Whether you need to take that risk is a question of your current position and what your goals are and the time, your time horizon in order to achieve that goal. But great question, Ron, and good luck with it. And thank you for the feedback. And thank you for everyone's feedback on the podcast. Tomorrow, Campbell's going to join you for an episode around the we call the super death tax. So that'll be an interesting one. And then I'll be back with you next week. Cheers. Just a few things before we wrap up, if I may. Of course, you can send me questions at investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.